Hello everyone and welcome to this module on debt to income ratio. In this module, we'll be discussing the front-end DTI and the back-end DTI in detail. Let's talk about the debt to income ratio. The debt to income ratio is abbreviated as DTI, and DTI is a ratio of how much money is spent on monthly debt payments versus how much money is attained each month. The front-end DTI, also known as the Housing DTI, takes into consideration housing-related expenses. On the other hand, there is another type of DTI called the Back-end DTI or the Total DTI, which takes into consideration all monthly debts. So the main difference here between the front-end DTI and the back-end DTI is that the front-end DTI takes into consideration housing-related expenses, whereas the back-end DTI takes into consideration all monthly debts. So let's talk about the front-end DTI. The front-end DTI can be calculated using the following equation. It's the PITI plus the HOA fees divided by the gross monthly income. Here, the PITI is an abbreviation for the principal, interest, taxes, and insurance of a mortgage. The HOA is an abbreviation for homeowners association fees. So you want to remember that to calculate the front-end DTI, you grab the PITI plus the HOA fees divided by the gross monthly income. So let's do an example for some front-end DTI practice. Jessica works as a financial analyst and is paid $5,000 a month in gross income. She has a PITI payment of $1,500 and pays $200 per month for HOA fees. She also has a car payment of $400 and a visa payment of $300. So what is her front-end DTI? Now remember, to calculate the front-end DTI, we grab the PITI payment, add it to the HOA fees, and divide by the gross monthly income. So we want to take into account her PITI payment, which is $1,500 per month, her HOA fees, which are $200 per month, and her gross monthly income, which is $5,000 per month. For the front-end DTI, we do not care about car payments or visa payments because these are aspects calculated into the back-end DTI, not the front-end DTI. So remember, this is the equation for the front-end DTI. It's a PITI plus the HOA fees divided by the gross monthly income. So you want to do this on your own. Pause the video and go ahead and do this calculation. Okay, so here is the answer for this question. It is $1,500 for the PITI payment plus the HOA fees of $200 divided by the gross monthly income of $5,000, which equals 0.34 or 34% for the front-end DTI. So let's talk about the back-end DTI. The back-end DTI is calculated using the following equation. It's the total monthly debts divided by the gross monthly income. Here, the total monthly debts include the borrower's payments for non-cancelable debts. And you want to remember this. These are debts that cannot be canceled. And non-cancelable debts include payments such as the mortgage or the PITI payment, HOA fees, car payments, credit card payments, and student loans. Now, non-cancelable debts does not include payments such as utility bills, grocery payments, and cancelable subscriptions such as a Netflix subscription. And a question stem on the NMLS exam may want to confuse you, so they may include utility bills and expect you to calculate the back-end DTI and include the utility bill as one of the total monthly debts. But remember, utility bills is a cancelable payment, and so you do not include that in the back-end DTI. Grocery payments would not be included as well, and any cancelable subscription would also not be included in the back-end DTI calculation. So let's do some back-end DTI practice. John works as a financial advisor and is paid $4,000 monthly in gross income. He has a PITI payment of $1,400 and pays $150 per month for HOA fees. He also has a car payment of $350 and a visa payment of $200. He pays $200 per month for utilities and pays $500 per month for groceries. What is his back-end DTI? So remember, for the back-end DTI, you include all monthly debts that are non-cancelable. You do not include things like utility bills or things like groceries for the back-end DTI calculation. Remember, this is the back-end DTI equation. It's the total monthly debts divided by the gross monthly income. Here, for the total monthly debts, we care about the following payments. His PITI payment, which is $1,400. His HOA fees, which are $150. his car payment, which is $350, and his Visa payment for credit card, which is $200. And we divide all of these by the gross monthly income of $4,000, and we get 0.525 or 52.5% for his back-end DTI. And this concludes our module on DTI.